Hey everyone, welcome back to Corporate Decoder. Today, BlackRock Monticello Debt Real Estate Investment Trust just filed an amendment to a credit agreement, and it looks like they are buying themselves some more time. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company has extended its borrowing deadline, and that tells us something about their current financial strategy. Starting with the basics, this filing is about a change to a loan agreement. This is for a company called BlackRock Monticello Debt Real Estate Investment Trust. Think of them as a company that deals with loans for real estate, specifically debt investments in real estate. Their ticker symbol, if you are looking them up, is likely something related to their business. But for this filing, the name tells us the most important part. The big event here happened on May 21st, 2026. This is when the company and JPMorgan Chase Bank, or JPM as most people know them, signed an amendment to a credit agreement. A credit agreement is basically a loan contract. So, they changed the terms of their loan with JPM. This section tells us about a significant new agreement. Remember that credit agreement from May 2025? Well, they just amended it. The most crucial part of this amendment is that the lenders, JPM, have agreed to extend the maturity date. This means the date by which the company has to pay back the loan has been pushed back. So the loan was originally due a bit earlier, but now it is extended to May 20th, 2027. That is a good chunk of extra time, and it gets even better for the company because they have the option to extend it further, up to another 12 months, as long as JPM agrees and other usual conditions are met. This is important because it gives BlackRock Monticello Debt Real Estate Investment Trust more breathing room. It suggests they might need this extra time to manage their finances or to complete projects before needing to pay back the debt. They also mentioned that the applicable margin was modified. In simpler terms, this means the interest rate or the fee they have to pay on this loan has changed. It could have gone up or down, but the filing doesn't give us the exact numbers here, just that it was altered. This is also a key part of any loan. It impacts how much the company has to pay in interest expenses over time. This section is a bit of a mouthful, but it basically means the company has taken on a new financial commitment or is involved in something that could become a financial commitment. Because this filing is about changing an existing loan and not taking out a brand new one. The details are already covered in the previous section about the amendment. It is more of a formality to say that changes to loan agreements are being reported. This part is where they list all the documents attached to this filing. The really important document is the actual amendment. This exhibit is the first amendment to revolving credit agreement. A revolving credit agreement is like a credit card for businesses. They can borrow money, pay it back, and then borrow again up to a certain limit. This amendment specifically changes the terms of that revolving credit. They've also noted that some parts of this amendment document have been intentionally left out. This is common for agreements like this where some details might be considered confidential or not critical for public disclosure. It could be specific pricing details not meant for everyone or other operational specifics. Now, let's think about what this all means. Why would a company need to extend a loan deadline? Usually, it is because they are anticipating cash flow issues in the short term, or perhaps they have ongoing projects that are taking longer than expected and need that loan facility to bridge the gap. An extension of a revolving credit facility, especially with the option for further extension, signals a company that is proactively managing its liquidity. It is a sign of confidence from the lender JPM that they believe the company will eventually be able to meet its obligations, but they need more time to do so. This is a common strategy for companies in the real estate investment trust or REIT sector, especially those focused on debt. These companies often rely on credit facilities to fund their investments and operations. When market conditions are uncertain or when specific deals are taking longer to close, extending credit lines can be a crucial lifeline. Consider this like needing to refinance a mortgage. If your home value dips or you are between jobs, you might ask for an extension to avoid a stressful situation. BlackRock Monticello Debt Real Estate Investment Trust is doing something similar with its business loan. The fact that they could negotiate this extension, and even secured the possibility of another extension, suggests they have a decent relationship with JPM, and that the bank sees value in continuing to lend to them. However, the modification of the applicable margin is something to watch. If the margin increased, it means their borrowing costs went up, which could eat into profits. If it decreased, it is a positive sign. Without the exact numbers, we can only speculate here. The omission of certain details in the exhibit may be hiding information about whether the cost of borrowing went up or down. This filing doesn't give us detailed financial tables in the body of the report itself, like a balance sheet or income statement. The focus here is purely on the credit agreement. It is worth noting that the company has identified itself as an emerging growth company. This means it is a newer public company and can take advantage of some relaxed reporting requirements. This often includes not having to provide as much historical financial data, which is why we might not be seeing detailed tables directly in this 8K filing. They are also checking a box indicating they do not want to use the extended transition period for new or revised financial accounting standards. This means they will adopt new accounting rules as soon as they come into effect, which can sometimes make comparisons across different periods more complex. The story here is one of financial management and stability. BlackRock Monticello Debt Real Estate Investment Trust is not in a crisis that requires immediate default or restructuring. Instead, they are taking a calculated step to ensure they have access to funds and the flexibility to operate without the pressure of an imminent loan repayment. This is a sign of a company that is navigating a potentially challenging economic landscape by securing its financial footing. The biggest question for investors right now would be, why the need for the extension? Is it a temporary cash flow hiccup, or are there deeper issues with their real estate debt portfolio? The lack of detailed financials in this specific filing makes it harder to answer definitively, but the fact they secured the extension implies JPM isn't seeing an immediate red flag that would make them pull their funding. The risk I am watching is whether this extension is a band-aid for larger issues within their debt portfolio. What I am actually looking for is more clarity on the modified interest rates to understand the true cost of this extension. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this helpful, give us a like and subscribe for more. Join our Discord in the description below.